Who would have thought? The start of 2024 has been way better in the markets than I would have expected after such a strong last year. Global stock market indexes are passing one all-time high after another, and as usually happens in this situation, I'm starting to see more comments and Reddit posts asking if now is the right time to buy ETFs or if you should wait instead. Let's see what history can teach us about what happened in similar situations in the past. Let's just say you may be surprised. We'll of course also take a detailed look at how each of my investments, ETFs, P2P Lending and crypto performed in January and any important events you need to know about up to today, February 9th, 2024. And finally, you'll find out how the state in the markets is impacting my own investment decisions right now. Let's start with stocks in the form of ETFs, the largest position in the investment portfolio I share with my wife. While I thought we would take a breather after such an impressive last year with returns of 17.8%, the rally kept going in January with our favorite ETF, the Vanguard FTSE World, finishing the month up 2.57%. And just 1 week later, as of February 9th, our ETF portfolio is already up 15,300 euros or 5.64% in 2024 alone. Now, how has the stock market behaved historically when something like this happened the last time? Meaning an annual return of over 15% the previous year, followed by a positive January as we've just seen. As it turns out, if history is any indication, there's now a 92% probability that 2024 is going to end on a positive note as well. 2018 was the only exception out of the last 13 times we were in this situation, with an average yearly return of 16.2% and a median of 16.3% in years like this. Which means this rally may be far from over. But that's not everything. Surprisingly, when looking at US data, which makes up the largest portion of global stocks by market cap, all-time highs in the market are usually followed by more all-time highs. Research by JP Morgan discovered that investing on any given date in the American S&P 500 index since 1988 returned an average of 12%, while investing on days where the market closed at all-time highs returned an average of nearly 15% per year. So the average returns were even better when investing at record highs, which may be surprising to hear. As a result, while it may feel uncomfortable at times to buy shares at all-time highs, there is no rational reason to wait, especially when you're investing over the long run anyway, which you should when you're considering ETFs in the first place. Now, does that mean we're only going up from here? Of course not. We'll keep seeing corrections or even crashes along the way, as these are a normal part of the journey and nobody can successfully predict when they're going to occur. In fact, I wouldn't be surprised to see a 10 or even 15% correction sometime in 2024, but I still think we'll finish the year higher than where we stand today. Either way, my wife and I will keep buying more Vanguard FTSE World ETF shares every single month. Speaking of that, I linked the best low-cost brokers in Europe for ETFs down below in the description, which is a great way to support me if you'd like to. And while you're there, don't forget to subscribe if you haven't yet. One of those brokers is Trade Republic, which we're also using as a high-yield savings account for our cash reserves, since they're paying 4% interest per year, secured by 100,000 euro bank deposit guarantee. In January, our cash earned us a record 65 euros and 52 cents in interest there. I'm also curious about the card that they're launching, which would enable my wife and I to spend more money directly from our savings account while still being able to earn interest on any money that's sitting there for monthly expenses. I'll let you know about my experience once I get my card, perhaps already in a few weeks. Alright, it's time to move on to my investments in peer-to-peer lending. I earned a total of 340 euros and 95 cents on 7 platforms I'm currently actively investing on. And here's how my money is distributed among them in percentage terms. As you can see, I decided to remove platforms I'm still in the process of exiting from this list in 2024, as I don't feel they deserve the extra exposure in my videos every month. One of those was Lender Market, where I finally received over 400 euros of remaining pending payments back, which I withdrew and moved to Via Invest. With only 36 euros remaining in long-term loans, I'm going to count this investment as finished in my own book. Okay, now on to my active investments in the space, starting with my largest one, Mintos. With over 76 euros in earnings, January was great overall. Sadly, interest rates have dropped significantly over the past couple of months, especially for the best rated lending companies. As a result, keeping up with the auto-invest has become more time consuming than I would like, so I'm considering making some changes to simplify it, or even to pick one of their predefined strategies, which would also enable me to liquidate my investments quickly under normal market conditions. Next up is Escatid, which ran smoothly without cash drag, so I have nothing to complain about. The same goes for Via Invest, where I had my best month so far with over 55 euros in interest payments. I moved the 480 euros I withdrew from lender market here in the end of January. Now, income also had a good month as far as earnings go, but the constant cash drag is becoming quite annoying. There were a few times in January where I manually needed to buy loans as soon as they were available, since the auto invest is too slow to pick them up before they're gone. Loan supply needs to increase soon, as I don't have time for this right now. Otherwise, I'll move some of these funds over to Via Invest and escalate it for the time being. Meanwhile, I had no issues on RoboCash, with the auto invest reliably reinvesting my funds whenever a bit of cash builds up. On Lande, another one of my loans was fully repaid, but the monthly interest payments were still a bit underwhelming due to a good portion of my loans still being late. That being said, I'm happy to see that Lande just received the new ECSP, meaning the European Crowdfunding Service Provider license, resulting in better regulatory protection mechanisms for investors due to the new regulation. Last but not least, I had a good month on a platform I added 2 months ago, Debitum, with over 33 euros in interest payments. All in all, I have to admit I'm not as excited about peer-to-peer lending as a whole in 2024 so far. That's in part due to the decrease in interest rates on my largest platform Mintos, or cash drag issues here and there, forcing me to spend more time on this small portion of my investments than I would like to. And probably also because what has been happening in the stock market or even crypto has honestly been a lot more exciting so far this year. But who knows, that might change in the coming months. Speaking of crypto, this brings me to my 10% target allocation to this highly speculative sector, namely my investments into the two largest assets in this space, Bitcoin and Ethereum. As so often is the case when you least expect it, after a strong rally at the start of January, the US Bitcoin ETF launch actually turned into a sell the news event. That being said, Bitcoin still finished January up 3% and is performing even better in February so far, but we'll see how the rest of the month goes. Meanwhile, Ethereum also had a positive month of January, with price increasing 2.3% and February also looking strong so far. It has been lagging behind Bitcoin though, so I'm curious to see if and when the trend is going to reverse. I'm still very bullish about these two in 2024, especially with the next Bitcoin halving coming up in April, which has historically preceded major price rallies in the sector. And the fact that large asset managers like BlackRock have just launched physical Bitcoin ETFs in the US definitely gave this asset class more credibility in my view. Still, as always, please make sure you understand how much risk you're taking here, so don't invest money in this sector that you absolutely can't afford to lose in a worst case scenario. Okay, let's quickly recap what I believe to be the most relevant portion of today's video for most of you. ETFs simply being at their all-time highs does not necessarily mean that now is a bad time to invest and that you should wait instead. After all, the stock market trends upwards over time, so it's completely normal for it to reach new highs on a regular basis. As I've shown you, at least based on historical data, there's a very good chance we may actually see above average double-digit returns this year. And record highs in the markets are usually followed by more all-time highs according to research by JP Morgan. Does that mean we won't see volatility or maybe even corrections of 10 to 15% along the way? Of course not. Those can always happen, but the problem is there's no way to know for sure if and when they're going to occur. For example, do we first go up 15% from here and then correct 10%? In that scenario, you would also be worse off waiting. There's just no way to know. I do believe a potential correction would be worth buying as well though, as I personally think prices will be higher by the end of 2024. Either way, timing the market almost never works out, so just stick to your long-term investment strategy and ignore all of the noise. At least that's what we'll keep doing. Before you take off, don't forget to gently tap the like button if you enjoyed the video and to subscribe if you haven't yet. If you'd like to support me, feel free to use my links in the description below to anything I mentioned in the video. And of course, none of what I talked about today was meant as investment advice. I'm just sharing my personal opinion based on my own experience as an investor. Thank you guys so much for watching, have a wonderful day, and until next time.